Welcome back to the deep dive. Last time, we really got into the law of demand. You know, how when prices go up, people generally buy less, that inverse relationship. But have you ever noticed how sometimes a product just vanishes? Or suddenly it's everywhere, maybe even cheaper? What's driving that? Well, today we're cracking open the other side of that equation, the law of supply. We're going to look at the market from the producer's perspective, the seller's viewpoint, our mission, to really unpack how producers react to price changes, sure, but also to all those other things influencing them. It's your shortcut to understanding this core economic idea. Okay, but before we dive deeper, just a quick reminder for everyone listening. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we're discussing is all derived from the amazing accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely check out the website. They've got loads of practice questions, video lectures, detailed support, perfect for reinforcing what we talk about today.
And a big thanks to Professor Farhat for providing this great material. All right, let's get started. Let's unpack this supply thing. Imagine this, just for a second. You make something, let's say, artisanal bread. You're the baker. And suddenly, the price people are willing to pay for your bread, it just shoots up. What's your first thought? More bread or less?
Oh, absolutely more bread. If you're the producer and the price goes up, assuming you're making a profit, your instinct is clear. You want to supply more. Higher prices mean potentially higher profits per loaf. You'd be thinking, how can I bake more? Maybe get another oven.
Right, that totally makes sense. The incentive is strong. So, flip side. What if the market price for your amazing bread suddenly tanks, drops way down?
Well, then the motivation just evaporates, doesn't it? If the price falls, your profit on each loaf shrinks, maybe disappears. You'd almost certainly cut back production. Why put in all that effort for less reward? The quantity you're willing to supply goes down.
Okay, so putting that together, unlike demand, where price and quantity kind of go in opposite directions,
Yeah.
for supply, it seems like price and quantity supplied are linked. They move in the same direction.
Exactly. It's a positive relationship. Price goes up, quantity supplied tends to go up, price goes down. Quantity supplied tends to go down, they move together, hand in hand.
So when economists get technical about it, what's the actual definition of supply they use?
The formal definition is pretty precise. Supply is the amount producers are willing and able to sell at any given price. And here's the key part. Given everything else is equal. That everything else equal is the ceteris paribus assumption we mentioned with demand. It lets us focus just on price for a moment. So the common idea, like you said, is prices rise, quantity supplied rises. Prices fall, quantity supplied falls. It's direct. And sometimes you'll hear aggregate supply. That's just the total quantity all the producers in a market are willing and able to offer together.
Okay, I can sort of picture that relationship. How does that look on a graph? Demand was downward sloping.
Right. Since supply has this positive relationship, if you put price on the vertical axis, the y-axis, and quantity on the horizontal x-axis, the supply curve will have an upward slope. It goes up from left to right. It visually shows that as the price climbs higher, producers are willing to supply a larger quantity.
Let's use that cheese example again, make it really concrete. Say I'm a cheese producer. If the market price is like $1 a pound, maybe I'm only willing to make 5 pounds. Not much incentive.
Okay. Yeah.
But if the price hits $2 a pound, now I'm thinking, okay, maybe I'll supply 20 pounds.
Right. The incentive is stronger.
$2 a pound. I'm pushing it to 35 pounds. $4 a pound, maybe I can manage 50 pounds. And if it gets crazy, like $5 a pound, I'm maxing out maybe 60 pounds of cheese.
That's a perfect illustration. Those rising prices are signals, they're powerful incentives. Producers see that and think, how can we get more out there? They might hire more people, use equipment more intensely. Now, this is generally a short-term view. Eventually, costs might start rising too if you push production too hard, but the initial reaction to higher prices is usually more supply. It's about that marginal revenue exceeding marginal cost, right?
Okay, so changes in the price of cheese itself cause us to move along that upward sloping supply curve. More money, more cheese supplied, basically. But what about other things? Things that aren't the price of cheese itself, but still affect the cheesemaker. How do these other factors maybe shift the entire curve, meaning more or less cheese supplied at every single price point?
Exactly. Those are the shifters. They change the underlying conditions of production. They affect the producer's ability or willingness to supply, regardless of the current market price for cheese. This causes the whole curve to move either right, meaning an increase in supply, or left, a decrease in supply.
Okay, let's tackle some of those. What about the cost of things needed to make the cheese? A change in resource prices or input prices? Milk is obviously key for cheese. What if the price of milk jumps up? Maybe feed for cows got expensive, or, like you hear about, shipping costs went crazy.
Yeah, that's a major one. If your inputs, milk, rennet, energy, even labor get more expensive, it costs you more to produce each pound of cheese. So at any given selling price for cheese, your profit margin is now smaller. That makes producers less willing or able to supply the same amount. So higher input costs generally lead to a decrease in supply. The curve shifts left. And the opposite is true too, right? If milk suddenly gets cheaper, maybe due to a great grazing season.
Ah, then it's cheaper to make cheese.
Exactly. Lower costs mean higher potential profits at any given price, so supply increases. The curve shifts right.
What about technology? That seems like it could shake things up. A change in technology.
Oh,
Imagine someone invents, I don't know, a super fast cheese aging process or a way more efficient pasteurizer.
Oh, technology's huge. Better tech usually means more efficiency. You can make more cheese with the same inputs or the same amount of cheese with fewer inputs. Lower costs, faster production. Either way, it makes producing cheese more attractive. So technological improvements almost always lead to an increase in supply. That's a shift to the right.
Makes sense. More efficient, more supply. What if the number of people making cheese changes? A change in the number of sellers? Like if a bunch of new artisanal cheesemakers pop up, or if maybe some big dairies decide to stop making cheese.
That one's pretty straightforward, logically. More sellers in the market means, well, more total cheese being offered for sale at every price. So an increase in the number of sellers shifts the aggregate supply curve to the right. Fewer sellers, less total cheese available. Aggregate supply decreases, shifting the curve left. Market entry and exit definitely matter.
Okay, what about the government stepping in? Changes in taxes and subsidies. Let's say the government puts a specific tax on each pound of cheese produced. Or conversely, what if they offer a subsidy, like a payment, to cheese producers?
Government actions can definitely shift supply. Think of a tax as an added cost of production. If cheesemakers have to pay an extra tax per pound, it increases their costs, just like higher milk prices would. Higher costs mean less profit, so supply tends to decrease. The curve shifts left. A subsidy is the opposite. It's like the government is helping pay some of the production costs. That lowers the producer's effective costs, makes cheese production more profitable, and encourages them to supply more. So subsidies shift the supply curve to the right.
Interesting. So taxes generally reduce supply, subsidies increase it. Now, what about the change in prices of other goods? This seems a bit less direct. How does the price of, say, yogurt affect the supply of cheese?
It comes down to producer choices and, well, opportunity cost. A dairy farmer, for example, uses milk. They could use that milk to make cheese, or they could use it to make yogurt, or bottle it as fluid milk. If the price of yogurt suddenly skyrockets, making it way more profitable than cheese.
They might shift their milk away from cheese towards yogurt production.
Exactly. They'll allocate the resources, in this case milk, maybe tank space, labor, to the product that gives them the best return. So if a substitute good in production, like yogurt, becomes more profitable, the supply of the original good, cheese, might decrease as resources are diverted. It's a subtle but important shift.
Okay, that makes sense. It's about where they can make the most money with their limited resources. Last couple of shifters here. What about producer expectations and maybe government import-export policies? How do things like anticipating the future or trade rules affect supply today? Like, what if the U.S. bans imported French cheese or starts subsidizing cheese exports?
These are about looking ahead. Expectations matter a lot. If cheese producers expect the price of cheese to be much higher next month, what might they do today?
Maybe hold back some of their current cheese supply, hoping to sell it later at the higher price.
Precisely. So an expectation of higher future prices could actually decrease the current supply, shifting the curve left temporarily. Now, about those policies. If the government bans French cheese import...
U.S. producers might think, great, less competition, maybe prices will go up or we can sell more.
Right. That expectation of increased demand and potentially higher prices could lead them to increase supply now, shifting the curve right in anticipation. Lifting import bans could do the opposite, flood the market, depress prices, leading domestic producers to decrease supply, shift left. And subsidizing exports makes selling overseas more attractive, encouraging producers to ramp up production, increasing overall supply, shift right. It's all about how policy changes the perceived future profitability.
Wow, okay. So there are quite a few things besides just the current price that can push supply around. Let's just recap that crucial difference one more time because it seems really fundamental. Movement along the curve, versus a shift of the whole curve.
Absolutely critical distinction. Let's nail it down. A change in quantity supplied, that's a movement along the existing supply curve from one price quantity point to another, is caused only by a change in the product's own price. Price of cheese changes, we move along the cheese supply curve. Full stop.
Got it. Price changes, move along the line.
Yep. But a change in supply, that's a shift of the entire curve, either left decrease or right increase, is caused by a change in any of those other factors we just discussed. Input prices, technology, number of sellers, taxes, subsidies, prices of related goods, expectations, government policies, anything but the product's own current price.
Okay. Price causes movement along.
Mm-hmm.
Everything else causes a shift. That clarity is key.
It really is. If you grasp that difference, you're well on your way to understanding how markets adjust.
So wrapping up, understanding this law of supply, really getting inside the producer's head, is just as vital as understanding demand for seeing the whole market picture.
Couldn't agree more. It shows you why things are available, why production levels change, and it's driven by these incentives and underlying conditions, not just consumer whims. And it really encourages you to think, beyond just the price tag you see, what's happening behind the scenes with costs, tech, competition.
Definitely. So here's a final thought for you to mull over. Think about a product you use constantly, maybe your smartphone. How might something like a disruption in the supply chain for a tiny component, or maybe a new environmental regulation on manufacturing overseas, affect the supply of that phone, even if the price hasn't budged yet? It connects all these ideas of inputs, policies, technology. A great way to see this deep dive playing out in the real world. And of course, if you want to explore these concepts further, practice problems, get more detailed explanations on supply, demand, and tons of other topics, farhatlectures.com is the place to go.